Opinions expressed herein are subject to change and not necessarily the opinion of the firm. Past performance is no guarantee of future results. The information presented herein is for informational purposes only and is not intended to provide personal investment advice. It is important that you consider your tolerance for risk and investment goals when making investment decisions. Investing in securities does involve risk and the potential of losing money. The material does not constitute research, investment advice, or trade recommendations.
And now introducing Mr. Keith Lanton.
This podcast was recorded on July 13th, 2020.
Hi, good morning. Hope everyone had a great summer weekend. Going to get us started this morning. Lots to talk about. A lot going on in the world, financial markets. A lot going on with the coronavirus. So we'll talk about all that. We'll also talk about some thoughts and ideas this morning about how to speak to friends and potentially convert them into relationships or clients in whatever business that you're in. So getting started this morning, I mentioned some thoughts on how you might be able to have friends become clients. Oftentimes, conversation or discussion with friends and talking about business is uncomfortable, and some people may choose not to in any way mix business and personal, and that's a personal decision, and that's fine as well. Others are open to working with friends. In many cases, it makes a lot of sense because friends are people you like, and you may want to do business with people you like. Oftentimes, it may be more enjoyable. In other instances, it may not be, and that's a personal decision. But for those who are interested in potentially working with friends that aren't currently clients, some thoughts on how to accomplish that. 3 to be specific. 1 is to offer to send something, but not just send something randomly. Because you're friends with someone, you often are in a situation where they're in an environment where they are in a situation where they're doing something they really enjoy. Perhaps you're with them at one of their greatest hobbies. So, for example, perhaps you're with a friend and you happen to be on vacation, and you happen to be going out to purchase a bottle of wine, and you know that your friend is quite the aficionado, enjoys reading every page of Wine Spectator, and this is something that's a passion of theirs. You might mention to that friend perhaps that the wine store that you're in is owned by a publicly listed company, or perhaps the wine that they are looking at is affiliated with a public company. And you may then say, "Hey, you'd be amazed at the businesses that this wine company owns, or this liquor company owns. They're in many multiple businesses." As a matter of fact, I was just reading a research report the other day on Constellation Brands, on Picard, Renault, whatever the company is. You know what? I'll send you a copy. Don't go to any trouble. It's easy. I'll just forward you a copy. Opens the door to a potentially a broader conversation. Another opportunity, changing gears, perhaps a different situation. This one is a little bit more planned. Perhaps you're a member at a golf club, or perhaps you are a member at a yacht club. It could be various different entities or affiliations, something that is your passion. And you have the opportunity to invite some guests for an event, and you give that some thought, and you choose 2 individuals who you think maybe enjoyable. Number 1 to spend the day with, and number 2 may potentially be potential clients in the future. So perhaps in the golf in a situation, you go out, you play around the golf, you don't discuss business. But over lunch, you may say something. May I call you up next week and set up an appointment? There's some ideas I'd like to share with you. I might be able to save you some money. Now, in this situation, you are to a certain extent in the driver's seat. You have invited them to your golf outing. You've shown them a wonderful day. On top of it, they've gotten lunch. And now there is an implied obligation. It is difficult to refuse the appointment that you have suggested. This is something that James McLaughlin, who was one of the best salespeople that I have ever seen, and Iris often told me that James McLaughlin also often said that in many situations when he has given someone something for nothing, whatever it is, he is creating a subtle obligation. Something to keep in mind if you are on the receiving end, that there is a subtle obligation that perhaps someone may want something in return. But he coined the term the subtle obligation of the sale, and that is in effect what is taking place here by inviting some prospective clients out for a round of golf. Finally, third instance is an instance where perhaps you are being solicited by friends to make a donation to a charitable organization. And oftentimes you may think to yourself, wow, I get so many of these potential invites, so many people asking me to donate to charity, but perhaps it's an excellent opportunity to raise your standing with that person, because obviously that charity and that gift is, donation, I should say, is important to them. So one thought is to make that donation. Obviously, you're doing good giving to charity, and then the second step would be to next follow up with that with a phone call, saying, "Hey, did you receive that check that I just sent over?" And at the same time, you might want to mention, perhaps it's a check to a friend who's a doctor. You can mention, hey, I happen to be giving a seminar for doctors. I'd love it if you could attend. It's next Thursday evening. Again, subtle way of opening the door. So, moving on to financial markets and where we stand this morning. We are seeing futures this morning once again to the upside. Dow futures up a little over 200 points. S&P futures are up 23. NASDAQ futures up over 100 points. On pace for a record again. And the Russell is up about 20 points. This is happening as we have second quarter earnings on deck this morning. Pepsi up about 2.5% to the upside after announcing results today, beating top and bottom line estimates. Also, we had a merger in the technology space, Analog Devices, symbol ADI, agreeing to acquire Maxim Integrated, symbol MXIM. At the same time as Analog announced that acquisition, they also issued third quarter guidance to the upside. So this morning we have Analog Devices, the acquirer, trading up about 2.5%, and Maxim, the acquiree, up about 20%. This is a $21 billion all-stock deal. There also remains some optimism on the coronavirus front. Pfizer, PFE, announced two of its COVID-19 vaccine candidates being co-developed by BioNTech, symbol BNTX, received fast-track designation from the FDA. Pfizer's up about a point, about 2.5%. BNTX is up about 10%, about 7 points this morning. Elsewhere, stocks in China continue to rally in a momentum trade. The Shanghai Composite gained 1.8%. The European stock 600 is currently up just about 1%. U.S. Treasuries are trading mixed. 2-year yield is down 1 basis point to 15 basis points. The 10-year is up 2 basis points to 65. We've talked about this before. Really not a lot of movement going on in the Treasury market, perhaps due to the Fed's hand there. U.S. dollar index down slightly, 0.2%. Crude this morning down 1.1% to 48 cents a barrel. We'll talk a little bit about some crude. What's going on there is the OPEC Plus nations, that's OPEC Plus Russia, are considering an output increase according to the New York Times, and that's what's weighing on those prices as they see the world opening up and perhaps being able to handle some more oil. But that obviously creating a situation where that greater supply potentially weighing on prices. New York Times is reporting that China is sanctioning U.S. officials. Barron's talking about that retailers are adjusting their offerings in response to the coronavirus. The Atlanta mayor has returned the city back to phase one, according to the local TV station there. Sure many of you have already seen the news regarding Florida. Over 15,000 COVID cases reported yesterday. That is the most for any state, and if Florida were a country, it would be number 4 in the list of new coronavirus cases, and that's including the United States, which is in the top 3 as well. Alphabet's Google said they're going to spend $10 billion in India, according to Reuters. Bloomberg reporting that Facebook may ban political ads during the election season. Tesla announcing that they are going to lower the price on their Model Y. That is according to Bloomberg. We had some analyst commentary this morning. We had Ellington Financial, symbol EFC. Some of you may own that. Is initiated with a neutral at Bank of America. They have an $11.50 target. Moderna, mRNA vaccine candidate for COVID, initiated with a buy at Jefferies. They have a $90 target. Viacom CBS initiated with a buy at Goldman Sachs, $34 target. Walt Disney, interestingly, initiated with a buy at Goldman Sachs, and they have a $137 target on that company there. Some news to keep an eye out for this week. What do we have upcoming this week? Tomorrow, second quarter earnings season begins in earnest. The largest U.S. banks report. First up are Citigroup, J.P. Morgan, and Wells Fargo, all tomorrow. Also tomorrow, we get the Bureau of Labor Statistics releasing the June CPI. Consensus estimate is for a 0.6% rise year over year. The core CPI is expected to rise 1.1%, roughly in line with May. Wednesday, we get more earnings, more banks in particular, but some others as well. BNY Mellon, Goldman Sachs, PNC Bank, U.S. Bancorp, and United Health Group, all with earnings on Wednesday. Also on Wednesday, the Bank of Japan announces its monetary policy decision, expected to keep their short-term rate at negative 0.1%. Thursday, we have earnings from Abbott Labs, Bank America, Johnson & Johnson, Morgan Stanley, Netflix, to name a handful. As you can see, the earnings are going to be coming in fast and furious. Also on Thursday, we have retail sales data for June, going to be carefully watched. Make sure that the economy is continuing to rebound. The expectation is for a gain of a 5.3% pickup in retail sales. Also, Friday, we get earnings from BlackRock, Kansas City Southern, State Street also reporting. We also get the University of Michigan releasing its Consumer Sentiment Index for July, and that is expected to tick up to 79.5. So, moving on to Barron's, a few different stories here and a couple of different ideas. One is about where we are in the markets. Interestingly, Barron's pointing out that it may not feel like it, but the S&P 500 index going into today is flat over the last month. So if you took a nap for the last month and you look back up, the S&P is almost exactly where it was on June 10th, despite all the volatility that's taken place in between. The S&P is about 3185 coming into today. And Barron's expressing some concern or caution with respect to the markets, thinking a lot of news is priced in, or good news is priced in. This may also be somewhat reflected in some of the sentiment that was in the cover story of Barron's, where they talked with Barron's roundtable members, and we'll talk a little bit more about that. But the general consensus there was that the markets were pretty fairly valued based on those quote-unquote experts. So looking forward, there's a lot on investors' calendars over the next coming weeks and months. The days of nothing but the latest coronavirus or economic data swinging the market in one direction or another might be ending. So what do we have that may start influencing the market that is different? Well, first off, we have earnings season, which we mentioned, which is coming this week. Everybody pretty much got a free pass last earnings season in terms of their earnings as well as guidance. The expectations are that investors are going to demand more this time, more color on plans, expectations, as well as perhaps more demands for more concrete numbers going forward. Also coming in the next couple of weeks could be greater clarity on the direction of the coronavirus outbreak, especially in several southern and southwestern states where there's lots of concerns about the spread of the virus and the trajectory there. Also, we're going to have some more information about whether or not we're going to see a new fiscal stimulus package out of Congress. As things currently stand, funding for the enhanced unemployment benefits and the small business paycheck program expire on July 31st and August 8th, respectively. That has some concerns about an impending income cliff in which millions of consumers see a sharp drop in their checks that they are receiving. On Thursday of this week, Treasury Secretary Mnuchin said that the Trump administration and Senate leadership will be discussing a new bill, singling out a period between July 20th and July 31st for passing it, pending an agreement with congressional Democrats. That could be another potential hiccup or boost for the markets in the coming weeks. And, of course, on top of all that, we enter election season. So lots of new factors coming into the market for investors to focus on. Barron's also talked about perhaps why we are seeing lots of strength in the markets, despite the fact that Main Street is not necessarily looking as bold as Wall Street. And they mentioned that the tech-heavy NASDAQ index has gained 18% this year after pretty much therefore ignoring the explosion of COVID cases, in particular the new cases in Florida and Texas. Nevertheless, markets ended the week with 3 consecutive highs, and Barron said perhaps that's for good reason. The index is composed of the kind of companies that can not only survive but thrive in a world where going about your normal everyday business could get you literally sick. Yet they point out that they are concerned that we've come to the point where these valuations are getting to levels that are becoming increasingly difficult to justify. Just last week, an analyst at Deutsche Bank raised his price target on Apple from $400 to $380. At the same time, he laid out a litany of concerns about the valuation for the stock. So something you don't typically can see is an increase in the price target, basically because the stock reached your target, and you've either got to raise your target or cut the stock to a neutral or sell. So in this case, raised the target, kept the buy, but came out with a list of reasons why he is concerned. Perhaps some other reasons that the markets are moving higher. Russell 1000 Growth Index was rebalanced on June 26th, and the combination share of Apple, Microsoft, and Amazon in that index rose from 25% to 28.6%. Why is that important? Well, just to get an index weighting, if you're targeting yourself to the Russell 1000 Growth Index, just to get an index weighting, it's going to require a lot of buying of those 3 stocks in order to equal the new weight. On top of that, many active managers were underweight those stocks relative to the index, and now we're further underweight, and therefore we're further underperforming, creating a further incentive for those managers perhaps to pony up and hold their nose and not be as underweight as they were previously. At Thursday's close, technology made up 28% of the S&P 500, perhaps one of the reasons it's been so strong. That's up from 21.5% just 3.5 years ago. The communication services sector, if you may remember, certain stocks like Facebook, Google, and Netflix were taken out of technology and added to communication services, is now 11.5%, up from 2.5% 3.5 years ago. So if you take that communication services sector and the technology sector, add it together, and you are at just about 40% of the S&P 500 being made up of stocks like Netflix, Google, Facebook, Microsoft, Amazon. You get the picture. So becomes increasingly less surprising why the S&P and why the NASDAQ are rising, given that they are made up of so few, but yet so much of these companies that make up a large portion of our economy, nevertheless representing a very large portion of the indexes. And what this means is that sectors that previously were very significant are largely becoming immaterial. So to give an example, materials are now 2.5% of the S&P 500. Utilities are 3%. Real estate is 2.8%. Energy has fallen from 7% to 2.5%. Even financials have slipped from 13.4% to 9.7%. So you can see how, as technology has risen, someone has to have fallen, and it is those other sectors. Moving on to the Barron's Roundtable, and I mentioned that the Roundtable crew confessed that they see little to like about the broad stock market, but they see much to admire in individual issues that have been left behind. This other portion of the S&P 500, perhaps, that is not participating. And most of their favorite names are drawn from tech, telecom, and healthcare. And I'll give a few mentions of a few of those stocks, just culling the list to what I thought was interesting, but certainly you may read it differently. One that was mentioned by Mario Gabelli is Next Era Energy Partners, symbol NEP, which manages renewable energy projects and grows through the development of wind, solar, and battery storage assets. They're targeting 16 to 19% total return. The company pays about a 4% distribution yield and is looking to grow that distribution yield at north of 10% for the next several years. Next up, conversation they had with Abby Joseph Cohn, who said that the stock market resilience has surprised her this year. She said much of the strength can be attributed to the Federal Reserve, which is using monetary policy, including new forms of monetary policy, to backstop the equity markets. Many equity investors realizing we are facing difficult times in coming months and beyond, but they're willing to look past that to what they hope will be a better picture for 2021. However, she says that the valuation models at Goldman Sachs suggest that the good news is already priced in, and she's concerned there's no reason to she's concerned that there is no margin for error in either equities or fixed income. Where does Goldman Sachs see perhaps better opportunities? She points to the expectation that you may see better performance in China, Europe, and Japan over the next 6 to 12 months, and that's all relative to the S&P 500. One stock that she mentioned that I'll share with you is SK Hynix, trades in Korea. It's the world's second largest supplier of semiconductor memory chips. She thinks that they could see additional demand from the resumption of the 5G smartphone cycle, as well as server demand, and she is interested in the stock mainly because of its valuation, which is basically trading at 6.5 times earnings. It's trading at book value and is yielding about 1.6%. A couple of other companies to mention to you here. In interview with the woman who runs Ariel Investments, Rupal Bansali, she mentioned China Mobile, CHL. Stock is sold off because of concerns about its delisting of its U.S. shares, because U.S. is talking about delisting Chinese shares. She feels that creates an opportunity with China Mobile now trading at around 9 times earnings and a 6% dividend yield. She also mentioned 3 names she felt were attractive in the pharmaceutical space: GlaxoSmithKline, GSK, 5% yield, offering single-digit organic growth; Gilead Sciences, symbol GILD, 3.5% dividend yield, underlying growth coming from its core franchise in HIV, as well as some potential growth from Remdesivir, its drug that is being used to treat COVID-19. And finally, she mentioned Roche Holdings, symbol RHHBY, a leader in oncology. Scott Black, who runs Delphi Management, was suggesting Bristol Myers Squibb, symbol BMY, trades around 60. This company yields about 3%. 8 of its drugs have more than $1 billion in yearly sales. Company has 9 drugs in phase 3. Figures it could commercialize 20-plus new drugs in the next 10 years. Taking a look at valuation, they're looking for Bristol Myers to generate $41.8 billion of revenue this year, earn $6.20. That's up significantly from the previous year because of their acquisition of Celgene. The stock is trading at 7.9 times expected earnings. And Bristol is expected to generate $14 billion of free cash flow this year. Return on equity right now is an astounding 26%. I could talk about a few other articles, but in the interest of time, I'm going to turn things over to Brad, talk some more about the financial markets. Good morning, Brad.
Morning, Keith. Thanks. Good morning, everyone. Hope everyone had a great weekend. I'm going to do something a little different this morning. I'm actually going to sell the product that I handle, municipal bonds, and talk about how cheap they are. I know I come on most weeks and talk about all the landmines that are happening in the municipal bond world, and there are and there could be more, given the uncertain nature of our future and coronavirus. But just to give you an idea of what's going on in high-grade bonds, the Treasury market, you have the 2-year bond at 0.15%, the 5-year at 0.3%, the 10-year at 0.65%, the 20-year at 1.13%, and the 30-year at 1.36%. So if you were to buy a municipal bond, historically, municipal bonds trade around 85% of those levels. So if you have a bond, if a Treasury bond that's at 1%, the prevailing municipal rate would normally be around 0.85%. Obviously, these rates are historically low and dizzying in a nauseating sort of way. But if you do have a place in your portfolio for high-grade bonds, municipals seem to be a pretty cheap option here. Just to give you a couple of specific examples, there's a New York City Municipal Water Authority, 3 5/8% due June of 2036, with a June 2024 call at 1% to the call in 2024, a 2.83% maturity in 2036. The ratio of that particular bond, it's 413% to the call and 300% to the maturity in 2036. These ratios are unheard of, and my thought is that certain municipal credits will hold value in a downturn in a higher interest rate environment, which obviously it still seems like we're a long way from seeing. One other bond, and I'm sticking with New York City Municipal Water because it's one of the few in New York that have no credit watch, no negative outlooks yet. But a New York City Water, 3% of June 2050 with a June 2030 call at about a 2.07% to 2030 and a 2.6% to maturity. The ratios are 315% to the call and 191% to maturity. So you have to figure, if we get back to normalcy, normalcy means a normal ratio versus treasuries. So as treasury rates go higher, you would have to assume, on a historical basis, the municipals tend to hold value a little bit better because they are a little bit out of sync here. The last one for the par buyers, I'll just show this last one. It's a Belmar, New Jersey school district that has BAM insurance, Build America Mutual, with a AA3 underlying, and it's at 2% of July 2038 at par, and that's 191% of treasuries. Having been in the business for 30 years, if you ask me if I like the rates, I have to tell you I don't like the rates. But when I look at it and analyze it in this regard as a relative percentage of treasuries on a historical basis, municipals are very cheap. And I hope everyone has a great week. Thanks.
Treasuries and municipal bonds are very different financial instruments bearing different risks and taxation. Comparing the yields are for informational and illustrative purposes only.
Thank you, Brad. That's everything I've got.
Thank you for listening to Mr. Keith Lanton. For more podcasts, please visit our website, www.lanternwa.com.